retire, you'll likely withdraw from several sources of income, such as retirement accounts, taxable investments, Social Security benefits. Let's break down the most common sources of retirement income and how they're taxed. First, we have traditional IRAs and traditional 401ks. Your traditional IRAs and 401ks are tax deferred, meaning that we don't pay tax on them up front. But when we go to take them out in retirement, we will pay ordinary income tax. Once we hit 72, we will have to take something called the required minimum distribution, which forces us to take money out of the account whether we need it or not. And again, we'll have to pay ordinary income tax. The next type of account is a Roth IRA or 401k. A Roth IRA or 401k will have us paying the tax today, but that money then will grow on a tax-free basis and we will be able to take it out not having to pay tax ever again. This is a nice tax advantage bucket that many people do not make full use of. Third, we have our taxable investments. Taxable investments are the least advantageous from a tax standpoint, but oftentimes the most beneficial from a liquidity standpoint. Profits from the sale of stocks, bonds, or other investments in our taxable accounts will be taxed at something called a capital gains rate that is dependent on what our income level looks like. Again, it's the least tax advantage bucket, meaning that we have to pay tax to get the money in there, ordinary income on our salaries, but then we also have to pay tax, the capital gains, whenever that money grows. The next source of retirement income that people often look towards is Social Security. Tax rates for Social Security depend on our provisional income, which is the sum of your adjusted gross income, tax-free interest from other investments, and 50% of your Social Security benefits. Lastly, we have annuities. Typically, we'll purchase an annuity with after-tax income. The annuity will then pay us on a monthly or annual basis. We'll have to pay tax on a portion of the income, which is represented by any growth in the annuity. However, our principal, should we have purchased it with after-tax income, will not be taxed. The important thing is to make a withdrawal plan. You might consider a plan that looks like the following. First, taking assets from things like traditional 401ks and IRAs to satisfy our required minimum distribution earlier on. Next, withdrawing from our taxable investments. And lastly, from things such as our Roth 401k or IRA. In order to accurately plan for your own retirement, it's very important to understand how all of the different tax implications work. If you still have questions about the tax effects of your retirement, give us a call and we'd be happy to provide you with more insight.